Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Mike Ambrosio, will provide you with insight and guidance on how to buy, sell, finance, and invest in real estate, and much more. And now, to guide you around the world of real estate, here's your host, Mike D'Ambrosio.
Welcome in. Good afternoon. This is Mike D'Ambrosio with Real Estate RE360 Radio. Thank you so much for joining us today. We have a great show in store for you today. I'll introduce my guests in just a minute. Just a reminder for those of you just tuning in, there's a couple different ways you can listen to our show. That is on the radio at KDOW 1220 AM. You can also listen to us live online at kdow.biz. We come to you 5 days a week. I'm on Mondays. We are on Monday through Friday from 3 to 4 p.m. We are also a live show and love your questions and your phone calls. So if you'd like to chime in, give us a call at 1-800-516-1220. That's 1-800-516-1220. And the question from last week, if you remember, you can call in and possibly win a gift certificate to one of our sponsors here. The question was, which stock market average does Silicon Valley real estate track closely with? So we'd love to hear from you. Love to hear your questions on the topic today. Also, you can check us out online on re360radio.com. And you can email me, Mike at re360radio.com. I'd love to hear your suggestions on possible shows for the future or any other suggestions that you might have. Love to hear from the listeners. So let's get into it. I'm here with Scott Poncetta with Intero Real Estate Services in Los Gatos. Scott is a multifamily and second unit and everything else specialist. He really does focus on investment properties, though, multifamilies to be more precise. And how you doing today, Scott?
I'm doing great. Thanks for having me, Mike.
Of course. Thanks for coming on. So let's get into it. A lot of you, for those of you that don't maybe know what multifamily means, we're talking anywhere from a duplex all the way up to 20, 30-unit apartment buildings, right, Scott?
That's correct.
Okay. Well, good. Well, how are the inventory levels looking on that right now?
Well, like residential, inventory is very tight, but it does seem like it's expanding a little bit lately. Here toward the end of the year, just like it mirrors the residential market, it kind of falls off right at the end of the year. But, you know, we do have, just to explain a little bit, we kind of break these segments into 2 to 4 unit properties, and then we have a second segment that's 5 plus.
What's the reasoning for that?
Well, it's just the way that when you have investors or buyers, they usually fall into one of two categories. And the 2 to 4, duplexes, triplexes, and fourplexes. And this is kind of your, I won't say more amateur, but the people that buy 5 plus units are usually more seasoned investors, sometimes institutional investors, where your 2 to 4s are a lot more mom and pop shops because they keep around the $1 million and lower price point.
Right.
So you really get kind of a different type of investor. So we generally break them up into those two categories. What
about the loans? Is that a little bit different too for the 4 and under? Isn't that considered residential?
That is. So yeah, it's a great question. And again, the 2 to 4s are the loans that you get they also mirror the residential market where you get a 30-year fixed loan.
Right.
When you move into a 5 plus, 5, 10, 15, 20, 25, any of those, you go to a commercial loan, and those loans, the maximum you can get on those loans is 10 years.
Right.
They're amortized over 30 years still, but the normal periods for a commercial loan are 5, 7, and 10-year loans rather than a 30-year loan.
Okay.
And so to go back to inventory, when I say tight, I do mean tight because when we focus on 3 counties, Santa Cruz County, Santa Clara County, and San Mateo County, and when you're looking at 5 plus properties on the market, right now, on the MLS anyway, there are only 23 total properties on the market.
Wow.
That's not a lot.
That's amazing.
That's less than 8 per county if you were averaging them. And for 2 to 4, you're always going to find a lot more activity. Things buy and sell a little bit quicker. And right now, in those same 3 counties, we have 77 properties available, anywhere ranging from $600,000 to $2 million.
Okay. And typically, the lower range ones would be in areas that might not be as desirable, whereas the higher price ranges are going to be in an area that's maybe, like a downtown Palo Alto or Cupertino, right?
Correct.
Yeah. And what about the return on investment on that? I mean, would you typically see, maybe talk a little bit about cap rates and what you would typically see in one area as opposed to the other?
Okay, yeah. Well, really, you're talking about when the question's about location, and when the question there is about location, and that is really when you move into the more desirable areas, kind of the pricier areas like a downtown Palo Alto, downtown Los Gatos, you are going to find a lower rate of return, but you have a lower risk in those properties as well. Now, you're going to get a higher rate of return in areas that aren't as desirable, and some poorer neighborhoods, some of the outlying areas of Silicon Valley, say Watsonville or Salinas. In those areas, you're going to get a better rate of return, but there's also a higher risk associated with those markets. Now, the higher risk is attributed to, right now we have a great rental market, but when we have down markets, that property that you might have in Salinas might be half empty in a down market, where if you have something in downtown Palo Alto, it's always going to be full.
Right. So that's why, like in a good market, that's why those rates of return on those areas that could possibly have a lot more vacancy, has a higher rate of return when the time is good.
That's correct.
If you're just tuning in, we're on RE360 Radio. I'm here today with Scott Poncetta, multifamily specialist. You can tune in online at re360radio.com. Give us a call if you have any questions about this at 1-800-516-1220. That's 1-800-516-1220. We'd love to hear from you if you have any questions. And so let's get into how you actually get into investing into some of these multifamily properties. And
Okay.
I know today's topic is underperforming real estate assets. So what that means is, you might have an investor or just, someone that just likes to invest in real estate, and they might have a single-family condo townhouse. Mm-hmm. How can they leverage that into a multifamily property, and what are some of the benefits of that, and how do you run the numbers on that going forward?
So when we talked about this particular show, it was really about, when I think about underperforming assets, you're talking about maybe a piece of property that's already paid for, and maybe not fully paid for, but you've had a property for a long period of time. And let's say it's a condo or a townhouse or a single family home, even a duplex. Now, if you've had it for a long period of time, you're getting a certain amount of return on that. This is very true mostly in single-family homes and condos that people have owned for a long period of time. Well, what I would do is I work with people that have those kinds of assets and say, okay, let's look at what your rate of return is on that, because that's usually a very low rate of return versus what you can do in a multi-unit market. So let's say you have a townhome in Mountain View that's worth $700,000.
Right.
That's a great asset. We'd all be lucky to have it. But if you have $700,000 in equity, we could leverage that $700,000 into a $2 million 15-unit building.
Right.
And the rate of return would go through the roof.
Right.
And so that's kind of what I talk about, or that's what I mean when I talk about underperforming assets. These are long-term, long holds that have kind of run through a cycle, and now you have equity there sitting there that's not generating what it could otherwise.
Right. And it's not to say that those single family or townhouses are a bad investment. I mean, they could possibly still be giving you a decent cash flow or, write-offs or whatnot. But what you're saying is that you can do better, essentially.
Yeah.
You can do a little bit better, and you can leverage that into something that can, A, get you more cash flow, and be a longer term investment over time.
Yeah.
So
no, in no way, shape, or form am I saying that's a bad investment.
Right.
Those have been great investments for a lot of people, but now there's an opportunity, and not just now, but anytime there's an opportunity to leverage that equity into something that's going to give you a higher rate of return and have an asset that appreciates accordingly. So,
right.
And just to talk quickly about appreciation, let's just take a modest appreciation number of, say, 3%.
Right.
Well, if you own something that's worth $700,000, like the example I just said, and it appreciates at 3% a year, if you own something at $2 million and it appreciates at 3% a year, you're talking about $14,000. Is that right? On the first one, no. I'm sorry, $2,100, and you're talking about on the other one $60,000. Right. So you really can, and I'm sorry, that's $6,000. But what you're talking about is multiplying that appreciation because of that asset that you own.
Right. Well, let's talk a little bit about maybe some of these. I know you were working with a client recently that was going through something like this, and let's get into that example a little bit, and we'll probably have to finish it up on the other side of the break. But let's start with that. So you had this guy in Palo Alto.
Yeah, this is a great example.
So he's got a single family house that's in Palo Alto, in downtown's worth what, $1.7 million.
Yep. And
in other areas would not be worth that. But hey, it's let's just start with that. So what can he do? What can he do with something like that?
Well, what we did was we did a full analysis on his property. We did find out that it was worth roughly $1.7 million. He doesn't owe anything on it. He's owned it since 1990. So he's had this investment for 23 years. It's been a great property. It's downtown Palo Alto, incredible. But he's got $1.7 million in equity. So what we did was we laid out some different options for him to move into multi-unit. So we laid out 4 different potential properties that he could buy with that capital. And then some of those also would be leveraged into much more expensive properties. So we took that 1.7 and we showed him how you could buy a 5-unit building for $1.7 million and just move that money straight across.
Yeah, it's a straight across trade essentially, right?
And then we did a $2 million building, a $2.4 million building, and a $3 million building.
Okay.
And just showed him if you leveraged your money over the course of a 10-year investment, that those accordingly, he would make up to $100,000 more per year, or over the course of 10 years, it would be $1 million that he would benefit above and beyond that Palo Alto piece of property.
On the biggest investment, right?
Correct, where he was leveraging his money at about 50%.
Okay. Nice. Well, let's get back into the numbers on the other side of the break. You're listening to RE360 Radio and Scott Poncetta from Intero Real Estate Services. We're talking underperforming real estate assets and how you can better leverage those assets. It's a fun topic. Happy holidays, everyone. We'll see you on the other side of the break.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Mike D'Ambrosio.
Welcome back. This is Mike D'Ambrosio with RE360 Radio. I'm here with Scott Poncetta from Intero Real Estate Services. We're talking underperforming real estate assets, multifamily investments, a lot of good stuff. If you have any questions on this, I know we just laid a lot of information out, and we're gonna get into some of those numbers in a minute. But give us a call. We'd love to hear from you. 1-800-516-1220. That's 1-800-516-1220. We love fielding your calls and answering any questions or concerns you have. And, just don't call us and ask us what you should get for Christmas for your wife or anything like that. I don't know.
I'm still trying to figure that out.
But yeah, give us a call if you have any questions. So let's get back into this real quick, Scott. Let's talk about, we were just talking about one of your clients, and he's got this great property in Palo Alto, single family for roughly worth 1.7 million. It's a great single family to own. And you kind of compared, you showed him a couple of options for him to leverage his money into something multi-unit to get better cash flow and appreciation and gain over a certain time frame. But let's use one example and maybe lay out how you got to those numbers. I think we're gonna talk about the 15-unit example you gave. It was probably I think it was the highest priced one, and how how he got $1 million more over that 10-year period as opposed to just keeping a single family and staying where he was at.
Right. Okay. So, when you break this down to the simplest way of thinking about it, you have a person that has one stream of revenue. Okay. He's got a single family home. He gets a lot of money for that one. It's a 2-bedroom home in downtown Palo Alto, but the way I try and explain multifamily to people in that investment is that he's getting one stream of revenue. Now, if you have a 15-unit building, you're getting 15 streams of revenue plus some other things, like laundry and what have you. Right. So in multi-unit, when you're thinking about investment, when somebody has a single family or a condo or a townhome, they are getting that one stream. But if you're going to put money into something, why not have a number of streams of income off of that same property? Right. It really matters what they all add up to, of course, but that's the whole idea about leveraging that property is let's build up what we're taking in gross revenues. And then you're subtracting out your expenses, of course, and it leaves you with a net income. So what we're really trying to do with this person or this example is show him how to use that, how to leverage that equity that he has in the home and just build it into a higher margin piece of property. Right. So in this specific example, and I did lay out 4 different potential properties for this particular client, but we'll just use the one. It's a 15-unit building in Santa Clara. And, on the surface, in year 1, he'll be taking in, or his net income on his property in Palo Alto is $46,000. Well, on the 15-unit building in year 1, it's $67,000, which is, $20,000 more. But it doesn't seem like a big number, but that number is going to continue to grow over time. Not only are the rents going to go up on both pieces of property, but the appreciative value of that property is also going to go up. Right. So those are the 2 metrics that really make this something worth doing for this particular client. Okay. So let's say after 10 years, then what is his income? What is the income looking like based on the original single family and the new property? Yeah. So at the end of 10 years on that single family property, he would have his net would have been $532,000, and on the new building it would have been $908,000. That's a cumulative of the 10 years of income. We're not just talking about 1 year. That's so I just want to clarify that for everybody. Correct. So there's roughly a $400,000 difference there. Right. But then the property value itself is what really changed, and that's the second metric that makes this really worthwhile, is that his piece of property in 10 years that's worth 1.7 today will be just under 2.3 million. Okay. And the property he was buying at $3 million is now going to be worth 4.1 million. Okay. So a lot more than the other one. Right? So when you add those 2 deltas together, that's what makes this really compelling. Yeah. Okay, well, we're going to get back into it after the break. Give us a call at 1-800-516-1220, 1-800-516-1220, here with Scott Poncetta talking about multifamily investments. You can listen to us online at KDOW AM 1220.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Mike D'Ambrosio.
Welcome back. Mike D'Ambrosio with RE360 Radio. We are on AM 1220 KDOW. Listen to us online at re360radio.com. You can also call us and ask us questions. If you're sitting on investment properties like this and you have any concerns, questions, comments, we'd love to hear from you. 1-800-516-1220, 1-800-516-1220. In studio today, live with Scott Poncetta from Intero Real Estate Services, multifamily specialist, and just a great guy. So let's get back into it. I'm sure there's people out there listening, and maybe they have an asset like this, and maybe they're sitting on a single-family condo, townhouse, even a duplex they could leverage into something different.
Absolutely.
If you're one of these people and you've been sitting on a property like this for 10, 20, 30 years, where would you go? What would you do with that asset? How would that work? What are some of the things that you can do and leverage it into something different and possibly better?
Yeah, that's a great question. And, people do come to me and they, we reach out for them a lot too. But if you, Mike, were to come to me and just say, hey, Scott, I'm sitting on this home in CalBRE and I've owned it for 30 years. I have two of them. And, it is underperforming. I want to do something with it. I want to generate more income. And
we all like doing that, right?
We all do like doing that, but this is actually specifically or very relevant right now to some elderly people that have been sitting on assets that are retiring, and they need this income, and they need to increase that income,
right?
Just to maintain their lifestyle. So these are the types of clients I work with a lot. And, if you were to come to me and say, I've got this single family home, what would I suggest? Well, we would consult with you and sit down and look at a variety of options. But the multi-unit area is definitely the area that I would direct them to.
Yeah.
And it has its pros and cons. And a lot of people don't think of this because that single family home is very low maintenance. It's not very much hassle.
Right.
And so when you get into multi-unit properties, of course, there are more phone calls, more plumbing issues.
Yeah.
And those, I know we're going to talk about that a little bit more, but if you came to me and said, look, I have this, we would say, let's look for something for you that's definitely going to generate more income for you every month.
Right.
And we can make that happen almost assuredly.
Okay. I know another concern, especially for some of the older generations too, or maybe if they've had this property for 20, 30 years, is taxes. Now they're worried about, I'm gonna have to pay higher taxes, because they have a tax basis of 1980 when they go and buy a new property, and they're paying $1 million plus for it. And for those of you that might not know, taxes are 1.25% of the purchase price. What can they do to avoid those taxes, or what can they do, to kind of remedy that situation?
Well, it is a great question, and it's usually the obstacle for a lot of older people that do have those kinds of investments.
Right.
They think, since my property taxes are so low because I've owned it for such a long time, that I can't buy something else, or they're fearful of the new property tax bill.
Right.
And don't get me wrong, that's real. Because it's a new calculation and 1.25% on whatever they buy. But we would only encourage them to make that move if, in fact, the bottom line improved.
Right.
And usually we can make that happen.
Yeah.
Not always, though. We really can't. If somebody's owned it for 50 years and they're paying $2,000 annually on property taxes, it can be difficult if I'm trying to show them a piece of property that's $15,000 a year in property taxes.
Yeah. We're going to take a quick break, but we're going to talk more about this on the other side of the break, especially if you want to pay $2,000 for taxes. You could call Scott. No, I'm just kidding. But give us a call, 1-800-516-1220. We are live on AM 1220 KDOW, RE360 Radio. I'm Mike D'Ambrosio. Thank you.
For more information on today's program, visit re360radio.com. That's re360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Mike D'Ambrosio.
Welcome back. I'm Mike D'Ambrosio with RE360 Radio. We are live on AM 1220 KDOW, live in studio with Scott Poncetta from Intero Real Estate Services, or Scott Ponchetta, as Joe Cachero would call you, right?
Yeah.
Give us a call if you have any questions for Scott, 1-800, or myself, 1-800-516-1220, 1-800-516-1220. We are in real estate. We do it every day. We love what we do, and Scott loves multifamily, and that's what we're talking about today. We're talking underperforming real estate assets as well as multifamily investments. And you mentioned plumbing issues, getting a call for a plumbing issue in the middle of the night, and I thought that was pretty funny because it's true. When you own a property like this, there's certain issues that come along with it, but there's also a lot of positives and upside to it.
Sure.
So let's talk. I want to really talk about, because some people are curious, like they have a single family or a condo, and yeah, there's typically not a lot of maintenance, or depending on the property, but usually you're not going to get those late night calls, or you're not going to have a lot of hassle. Mm-hmm. But let's talk about the pros and cons of owning a small multi-unit complex, so anywhere from a duplex to a fourplex, as opposed to owning a 10 to 15 unit apartment building.
Yeah, great. Yeah, so you could even say what's it versus a single family, right, versus a small multi-unit versus a large multi-unit. So, right. I just got a call on one of my rentals on a furnace on Saturday, and yeah, it's annoying. I'm Christmas shopping with my wife, and I get that call. So that's a small one for me, but anyway, so the difference is that and it's a legitimate concern. When you have a single-family home or something small, and it's fairly easy to manage and maintain, and then you step up and you have, yes, now I have 3, 4, 5 streams of income, but I also, and the way it's properly interpreted, is I also now have 5 people that I cater to instead of 1, right, meaning that I have to manage, or problems, or that many more toilets, or that many more roofs.
Right.
So it's a legitimate concern, but it just all falls into the bottom line. And when you do, so most people, when they manage a single family home, manage it themselves.
Right.
Most people, even when you go 2 to 4 units, most of the time they manage that themselves as well.
Right.
So now that is a concern when I have 4 different tenants instead of 1 tenant. So, but then when you get above 5 units, that's when we generally hire property managers.
Right. And what's typically the cost for a property manager for those listening that might not know?
A good number to use is 7% of your gross receipts.
Got it.
Some people can negotiate that down, and some people pay more than that, but probably 7's a good number. If you've got 15 units, 6 is a better number. You can get it. The more units, the more you can negotiate it down.
There you go. Negotiation skills from Scott Poncetta.
Yeah. So, there's an increase in hassle with your increase in dollars.
Right.
And that's just the way that it works. So you can't really avoid that. Then also, this came up in that conversation with that client was, hey, I've got a 1,300 square foot home, and if it needs a new roof, that's going to be $8,000 or $10,000. If I've got a 15-unit building and it needs a new roof, that could be $50,000.
Right.
So, of course, when we do an analysis, we factor those things in. But again, it's bigger dollars coming in, usually more headaches, and potentially larger capital investments.
Right. So then let's talk about let's use the roof example. Let's say then you had 3 fourplexes, or 3 fourplexes versus 1 large 12plex.
Yep.
Right. So why might it be good or bad to own the 3 fourplexes as opposed to just one building with one set of hassles, or vice versa?
Okay. And that is a question that comes up a lot. And there are a few things. Is that when you own 3 fourplexes versus a 12-unit building, very simplistically, you can get better loans on those 3 fourplexes.
Because it's residential loan, right?
That's right, because it's a 30-year fixed loan.
Right.
So we talked about that a little bit earlier. So there's one advantage to three, and I'm not saying I like one over the other, to be honest with you. That's one advantage, though. The disadvantages that I see on something like that, right off the top of my head, are you have 3 different properties in 3 different locations.
Right.
So if I'm managing those, whether I have a property manager or not, I have to go to 3 different places to fix things or to meet a contractor of some kind.
Right.
When you have everything under one roof, there are more units, but it's one location that you have to kind of manage and take care of. There's a hassle factor. Mm-hmm. Those are kind of the off the top of my head pros and cons. The books are a little bit harder when you have 3 different buildings. Just the accounting is a little bit more complex.
Right.
But another upside to 3 different types of buildings is you could put them in different locations.
Right.
And so you're diversifying that asset a little bit, and that's going to lead us into a discussion about 1031s in a couple minutes, but 1031 exchanges is what I'm talking about. But those pros and cons, they're definitely, you need to know those going in. And also a good bit of information on this topic is that state mandates that once you get above 16 units, you have to, at 16 and more, you have to have an on-site property manager. Right. So you have to account for somebody living in one of your units and managing that building from that location.
Would you say having 3 separate fourplexes, for example, as opposed to a 12-unit, maybe those fourplexes are a little bit more liquid than having a bigger building? So, let's say you needed to liquidate or use that money for something else. Would you say that maybe it's a little easier to unload those as opposed to a bigger building, or what do you think about that?
No question. You must be in real estate.
Was that a setup question?
That there's no question that having the 3 fourplexes over a 12-plex offers you more flexibility.
Right.
Yeah.
Well, we're going to get back into it after the break and talk 1031 exchanges and wrap everything up. I'm here with Scott Poncetta in studio live on AM 1220 KDOW on Real Estate 360 Radio. I'm Mike D'Ambrosio, and Scott Poncetta is my guest today. Welcome back on the other side.
For more information on today's program, visit RE360Radio.com. That's RE360Radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360Radio.com. That's RE360Radio.com. Again, your host for today's edition of RE360 Radio, Mike D'Ambrosio.
Welcome back on RE360 Radio, live on AM 1220 KDOW. We're talking anything and everything real estate, providing you education and information. We're live in studio today with Scott Poncetta from Intero Real Estate Services, multifamily specialist. So let's get back into it because we've only got a little bit of time and then we got to go. But I wanted to, now let's kind of wrap this up. I got a single family property. Everyone knows that the last couple of years in real estate have been good. We've gotten a lot of appreciation. I want to sell it, but I don't know what to do with that capital. What do I do? Where do I put that capital? How do I avoid the government taking my money as much as possible?
Yeah, no. That's an awesome question, Mike. And and we do get people that come to us and say, it's time for me to liquidate this asset, but what am I going to do with that money so I don't pay taxes? Well, when you have a piece of real estate, the only thing that you could move that money into without paying those capital gains, and just to review on capital gains, is let's say I bought it at $200 and I'm selling it at $700.
Right.
So I have a $500,000 capital gain. Well, the only thing you can do to avoid paying taxes on that money is to move it into another real estate investment.
Right.
It has to be a like-kind investment. So my point is it has to move into real estate. So this is exactly when you'd want to go into multi-unit. But you can't liquidate that money and then put it into the stock market or some other kind of investment that's not real estate related, or else they will get you for that $500,000.
And the name of that is called 1031 exchange, which will have a whole nother show on. We'll probably bring in a 1031 guy. I know this, the show has had a few guys on before to talk about it. But let's get into how can people reach you? How if they have questions on multifamily and all that good stuff. Let's give them your information.
Yeah, well, my name again is Scott Poncetta, and that's Poncetta, and I have PoncettaRealEstate.com. That's a great way to get in touch with me. My phone number also is 408-757-1007. That's here in the Bay Area. I really work on these 3 counties, meaning Santa Clara, San Mateo, and Santa Clara counties. I focus on those, but I certainly can help people that are looking for investments outside of the area as well.
Excellent. Well, thanks for coming on today. I really appreciate it. I think we provided some good information, and your expertise is second to none. So I really do appreciate you coming on today. So the question of the day is, how many units, if you were paying attention, and I hope you were, how many units do you need to be considered a commercial property? So feel free to email me throughout the week or call me, and you can win a gift certificate to a special restaurant in the family. So that question again is, how many units do you need to be a commercial property? You can email me, Mike at RE360radio.com. You can call me at 408-357-6177. That's 408-357-6177. If you or your family members missed today's show, you can go online and listen to the playback on RE360radio.com or KDOW. And we'd love to hear from you guys. Feel free to call in anytime, email us. I want to wish everyone a happy holidays. I know Christmas time can get a little hectic. I think, Scott, you're going to go shopping for some gifts right now, right? So
yes, I am.
So good luck with that. Good luck with the crowds. But I want to thank everybody for listening. Have a great day. This is Mike D'Ambrosio with RE360 Radio. This is Mike D'Ambrosio with RE360 Radio, live Monday through Friday on AM 1220 KDOW. Have a great day, everybody.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.